Welcome to the deep dive. We've got a really interesting set of documents today, all centered on Constellation Energy Corporation, the big nuclear power player, and their recent results through Q3 2025.
Yes, a lot to unpack.
It really is, and this deep dive feels necessary because, look, understanding Constellation isn't just about glancing at their net income line, right? It's more about figuring out how they're positioning themselves, really right at the heart of this whole clean energy transition.
That's spot on. Our mission today is kind of threefold. First, pull out those core performance indicators, what really matters. Second, we need to untangle this paradox around nuclear subsidies. It's a bit strange.
Yep.
And finally, connect the dots. You've got this massive Calpine acquisition alongside some really crucial regulatory wins. How does that all shape their strategy for, literally the next 50 years?
And right off the bat, we hit this big structural challenge. You look at the raw financials, the GAAP numbers, and it's choppy, super volatile.
It is, because standard accounting, GAAP, has to include every little market swing, every fluctuation.
But Constellation, they're trying to run reliable power plants day in, day out.
Right.
It's not a trading operation primarily. So how do they actually track their own success internally?
Right. They use non-GAAP measures, which, is pretty common in this sector. Management uses these alternative numbers not just for reporting, but to actually run the company.
Okay.
Yeah, for evaluating how things are going, deciding where to put resources, and yes, setting bonus targets too. They're essentially telling us, look, this is the financial story we're focused on.
Okay. So let's break down the two big ones they use. First up is adjusted operating earnings. What's that about?
Adjusted operating earnings, it's basically management trying to filter out all the financial static that doesn't really reflect the day-to-day business of generating electricity.
So taking out the noise.
Exactly. They strip out things that are super volatile, like mark-to-market adjustments, MTM, from their economic hedges. These are just paper gains or losses based on where the market thinks future prices might go, not actual cash today.
Okay.
They also pull out stuff like asset impairments, big one-off costs. The goal is always to show the predictable, steady earnings power, especially from that massive nuclear fleet.
Hold on, though. If you strip out all that volatility, like the MTM swings, aren't you potentially hiding the real risk? They operate in a market with huge price swings. Isn't ignoring that hiding something important?
That's the critical question you always have to ask with non-GAAP. Absolutely. Management's argument is, look, these hedges are meant to lock in future prices, stabilize things down the road, but their current value on paper swings wildly.
Right.
They also exclude other fair value changes like minor gas imbalances or changes in the value of the stocks and bonds held in their nuclear decommissioning trust, the NDTs.
The funds set aside for dismantling plants later.
Exactly. When the market value of those investments jumps up or down, it hits the GAAP bottom line, but it doesn't change how much electricity they sold today, right? They're trying to focus on the nuts and bolts of the power business.
That helps clarify it. It's kind of like looking at your household budget. GAAP is the whole picture, including maybe a surprise bonus or a sudden big repair bill. Adjusted earnings is more like just your regular salary versus your fixed monthly costs, the predictable part.
That's a great analogy. Precisely. And the second key metric flows from that, free cash flow before growth, or FCFBG.
XCFBG.
This is their cash from operations minus only the capital spending needed for basic maintenance and, crucially, nuclear fuel. It shows you the underlying cash engine, the money that's potentially available for the big strategic stuff like acquisitions or building new things before they actually spend on that growth.
Okay, this sounds like sensible internal accounting, helps them manage. But there's a catch, right? A limitation they flag about using these metrics for forecasting.
Yes, and this is the big asterisk. Constellation says quite clearly in their filings, we cannot reconcile our future projected non-GAAP numbers, like their forecast for adjusted operating earnings, back to the comparable GAAP figures.
Why not?
Because it's just too uncertain. They can't reasonably predict those future fair value adjustments, especially the MTM on derivatives and the swings in those NDT fund values. It just highlights the incredible volatility they have to navigate. They basically admit they can't guess what the GAAP markets will do even a few months out.
Wow. Okay, that really sets the stage for looking at the actual Q3 2025 performance. Because like you said, when you look at the numbers, GAAP and adjusted earnings are telling completely different stories.
Totally opposite, yeah. If you just look at GAAP net income for common shareholders, it looks rough. It fell sharply from $3.82 a share in Q3 24 down to $2.97 in Q3 25. On the surface, that looks like a problem.
But their preferred metric, the adjusted operating earnings, that actually went up.
It did. Improved from $2.74 per share to $3.04 per share. So despite that JAP hit, management is saying fundamentally the core business got stronger.
What drove that improvement, then?
It really came down to good operations. They had significantly fewer nuclear outage days compared to the year before, and they earned higher capacity revenue. The fleet just ran incredibly well.
That operational excellence number jumps out. Nuclear capacity factor was, what, 96.8%?
Almost 97%, yeah. Really impressive for the quarter. They cranked out 42 terawatt hours of power, just solid performance.
Okay, now let's get into this nuclear paradox you mentioned. This was genuinely surprising when digging through the sources, the Nuclear Production Tax Credit, the PTC. The benefit they recorded from this dropped massively, didn't it?
Oh, massively. It went from $670 million recognized in Q3 of 2024 down to only $175 million in Q3 of 2025.
Huge drop. Why?
It's because they were, in a way, too successful in the open market. So the PTC, it gives a tax credit up to $15 per megawatt hour for nuclear generation in 2025. And it's transferable. They can sell it if they don't need it.
Okay, standard subsidy, but there's a catch.
There's the crucial detail, the phase out. The PTC starts to disappear as the power plant's annual gross receipts from selling electricity go up. It's designed to help when market prices are low. But in Q3 2025, Constellation actually benefited from significantly higher market energy prices. And those higher revenues push their total receipts above the threshold where the government subsidy starts phasing out.
Hang on. So they made more money selling their actual product, electricity, on the market.
Right.
And because of that success, the government subsidy designed to help them went down. They got penalized for doing well commercially.
That's the paradox in a nutshell. It's a fascinating tension in how energy policy works sometimes. There's strength in the market, and you see that strength reflected regionally too. Good results in the Mid-Atlantic, Midwest, ERCOT, thanks to hedges and higher contract prices. That commercial success directly cut their government support.
They basically traded subsidy dollars for market revenue dollars.
Exactly, which arguably shows the underlying business is becoming more resilient on its own.
Okay, this is where it gets, as you said, really interesting strategically.
Yeah.
Because that strong operational core, even with the weird PTC effect, is what lets them make big moves. Let's shift gears to the future-shaping stuff, starting with that huge Calpine acquisition announced earlier this year.
Yeah, this is a massive deal, and it's not just about getting bigger. It's a really strategic pivot. Constellation is the king of nuclear, clean, carbon-free, always-on power baseload.
Right.
But the grid today needs flexibility, right? Things that can ramp up and down quickly. Calpine brings that. Reliable, dispatchable assets, mostly natural gas, but also geothermal, batteries, some solar. It takes Constellation from being mainly a nuclear company to being a much more integrated energy provider built for a less predictable grid.
And the scale is just enormous, heading over 27 gigawatts of capacity, plus a big retail business serving 60 terawatt hours a year.
Huge. The deal structure reflects that scale. It's about $4.5 billion in cash. Plus, they issued 50 million new shares of their stock. And importantly, they're taking on roughly $12.7 billion of Calpine's existing debt.
And the regulatory side, has that moved forward?
Yes, crucially. By mid-2025, they'd gotten the key approvals needed from state regulators like the PUCT in Texas, the NYPSC in New York, and the big one, the Federal Energy Regulatory Commission, FERC. That clears the path for the deal to actually close.
Okay, so big M&A moving forward. But Constellation also locked down some major regulatory certainty for their existing assets this year too, right? Let's talk federal support first.
Yeah, there was important legislative action. This one big, beautiful Bill Act of 2025, OBBBA, signed in July. It basically reaffirmed support for nuclear power.
How so?
It preserved and even enhanced some key federal tax credits that came out of the Inflation Reduction Act, things like 45U and 45Y, which support clean hydrogen and advanced nuclear tech. It's like long-term economic scaffolding for their clean energy plans, making those investments more viable for the long haul.
But maybe even bigger were the wins for specific massive power plants. Getting operating certainty there must have been huge.
Oh, absolutely critical. First was Peach Bottom, Units 2 and 3 in Pennsylvania. The Nuclear Regulatory Commission, the NRC, finished its environmental review. The result: it restored their operating license expiration dates way out to 2053 and 2054.
Wow. Decades of certainty.
Exactly. It resolved this cloud that had temporarily shortened their licenses. That's a monumental win for such a key asset.
And the second big one was Conowingo, the hydroelectric dam. That one also got resolved, but it came with a bit of a price tag, didn't it?
It did, yes. Conowingo is another major power source for them. Securing its future meant reaching a final settlement agreement with environmental groups and the Maryland Department of the Environment, the MDE, mainly about water quality issues.
And that settlement now allows FERC to issue a new 50-year license.
That's the prize. 50 years of operating certainty.
Right.
There's a cost.
That's the annual hit.
The estimated cost to comply with the settlement, things like changing water flow patterns slightly, funding fish passages and water quality projects, it's projected to be around $15 million to $20 million per year on average over that whole 50-year license term.
Okay, 15 to 20 million a year. That sounds like a lot, but I guess over 50 years for a major hydro asset.
Exactly. You have to weigh it against the value of having that asset locked in and operating predictably for half a century. It's a significant cost, but probably a very worthwhile investment for that kind of long-term stability.
Makes sense. And just quickly before we wrap up, they also touched on supply chain risks, specifically for nuclear fuel.
Yes, that's a big focus, especially given, global instability and the U.S. ban on Russian uranium imports. They're actively signing more long-term contracts to build up their fuel inventory and making sure they have diverse suppliers, both domestic and international allies. It's all about protecting the core operational reliability of those nuclear plants.
Okay, so let's try to pull this all together. We've got stronger core results, this big expansion with Calpine, crucial regulatory certainty. What's the overall narrative for Constellation coming out of Q3 2025?
I think the narrative is they delivered really solid underlying operating results, proving they can manage market volatility effectively, focusing on running their plants well. They showed commercial strength, even if it meant, paradoxically, getting less government subsidy money.
Right.
And that operational stability, that strong foundation, is what's allowing them to make these aggressive growth moves like Calpine. And those moves are only really possible because they also managed to lock down that long-term regulatory certainty this year for huge assets like Peach Bottom and Conowingo. It all fits together.
So what does this all mean? The bottom line seems to be, yeah, they've achieved these massive strategic wins. The Calpine deal is moving. The licenses are secure for decades. But the entire strategy, everything they want to do, seems to be constantly shadowed by one key vulnerability.
That's it. That's the crucial takeaway for you, the listener, to ponder. They're performing well operationally. They reported, over $4 billion in cash on hand, more than $7.3 billion in total available credit. Looks good on the surface.
Wow.
But their financial flexibility is still incredibly sensitive to their credit rating. The documents highlight this. A hypothetical downgrade of just 3 notches, which would push them below investment grade, that alone would instantly trigger a requirement for them to post an estimated $2.44 billion in extra collateral, mostly for their derivative hedges.
$2.4 billion, just like that.
Just like that. A massive immediate cash call. It's like the sword of Damocles hanging over everything. That kind of cash drain would put immense strain on their balance sheet. It could complicate financing for deals like Calpine, maybe derail future growth plans entirely. It just forces you to think about how much these huge energy strategies depend not just on generating power reliably, but on maintaining that stable balance sheet, that investment-grade credit rating, especially in today's really volatile global markets. That rating isn't just a score, it's basically the key that unlocks their entire future strategy.